Welcome to the Michael Yardney podcast, your go-to place for insights into Australian real estate, wealth creation and success strategies. Now, today we're diving into a topic that's been making some waves in the property market. I'm joined by Julie Toth, Chief Economist at PEXA, to discuss the findings of their 2023 Cash Purchase Report, which sheds light on a startling trend. Over a quarter of residential properties in Australia's eastern states were bought with cash, no mortgage, in 2023. Now, obviously, these cash buyers were immune to interest rate hikes, and in a market totally swayed by mortgage rates and lending criteria, that was quite different. So, together with Julie, we're going to explore the implications of this trend, actually profile these cash buyers, tell you who they are, where they're buying, and what it all means for the future of our property landscape. So, let's get into the heart of what's happening in our property markets right here on the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Julie.
Good morning.
Now, Julie, I know about PEXA, but maybe you could explain a little bit about PEXA, PEXA's role, and explain what your organisation does and what your role is there at PEXA.
Yeah, sure, Michael. PEXA is the Property Exchange Australia. It's a digital platform that handles transactions for all properties and all mortgages across Australia.
So in the old days, Julie, people used to have titles, paper titles, and the conveyancer would come from one side and the other side and the bank would be there and they'd swap documents. That's no longer the case. Is that right?
Well, Michael, Australia is still in transition to full digital e-conveyancing, so we're almost there in most of the mainland states. However, Tasmania and the Northern Territory are still transacting on paper, but we do have a timetable for them coming on board. So over the next 2 years, it will be a full national digital system. We're also rolling this out in the UK, so they're going digital too, courtesy of an Australian tech company.
Isn't that great? And you're the chief economist there.
Correct. I'm the chief economist at PEXA, looking at property markets, demographics, and of course mortgage markets.
Well, you've got access to all the conveyances in the mainland states, so that's really interesting. And you recently released PEXA's 2023 cash report. And I was surprised. I got last year's one, but I was really surprised at how many transactions occurred last year without a mortgagee involved. So maybe you could just give us an overview, start with an overview of the key findings of PEXA's latest report.
Yeah, sure. Now, one of the advantages of the PEXA digital conveyancing is that, there's details of property transactions that have probably always been there, but they haven't been visible to us. So what we've done with this one is look over the last 4 years at how many properties, in this case residential properties for our 3 largest states, were conducted without a mortgage attached to the sale. So that means the buyer didn't need to take out a mortgage in order to complete the transaction. And it includes all residential sales, including residential land actually, which is an interesting category for cash purchases.
What was the findings? What did you find?
What we found was the total proportion of residential purchases across those 3 states was relatively stable at around 25% from 2020 to 2022, but it jumped up to 28.5% in 2023, which is actually quite a big jump, and it was particularly pronounced in Queensland. So across those 3 states, Queensland has consistently had a higher proportion of cash purchases than New South Wales and Victoria, 29% in 2023.
Well, that's interesting. So well over a quarter of all properties being purchased were purchased for cash. And that was, I guess, at a time when interest rates were higher and there was a lot of talk about the Reserve Bank wanting to slow down our economy by raising interest rates and it affecting different people. But clearly, some people are not really relying on mortgages or interest rates, are they?
Yeah, that's right. And I think that actually helps to explain for us some of the resilience that we've seen in the property market over this period. Quite frankly, it was a little bit of a puzzle to many property experts why we saw prices and transaction volumes rebound, even though interest rates were still trending up.
Well, everyone said it was supply and demand, but clearly you've got another. There is an element of that, but boy, you've got another dimension to it, haven't you?
It is. So we've got this collision of the supply and demand factors, the fundamental drivers, but we also have the ageing population and quite a bit of interstate movement, intrastate movement over this period, which is driving, quite a bit of mobility for those that already own homes. And that's largely what we're seeing in these data.
Well, you in your report suggested that the cash buyers tended to be older and possibly retired people. Can you maybe expand a bit more on the demographic profile? Were you able to tell that?
That's right, Michael. So the PEXA data, we do keep the demographic details of buyers and sellers confidential, of course. But what we did was look at the locations and the types of properties that are involved in these transactions. And that does tell us a lot about the broad demographics of those who are involved. So the most popular postcodes for cash purchases in terms of the number, but also the proportion, are exactly those postcodes that we typically see for sea change, tree change type retirement activity.
Interesting. And so therefore it's assumed that it's right sizes. I don't think my generation like to be called downsizes anymore, Julie. And more so in Queensland. But Queensland's a big state. What were some of the areas that were in particularly had more cash purchases?
Yeah, so with the downsize idea, I think that came about because of the price points that we're looking at, because the proportions of cash buyers are actually higher in some of those regional areas with lower purchase prices, average purchase prices. So one of the highest, for example, a fairly small postcode area, Tara in Queensland, followed by Russell Island, Gin, Magnetic Island.
So there may be more holiday home locations, are they, or vacation home locations, or downsizing as opposed to first home buyers or people upgrading their home?
That's right. All of those things are possible. So, or all of those situations rather are possible. So we can't see exactly, what people are using these homes for, but they are areas and locations that, as you say, are popular for holidays, for retirement activity, rather than, young working family destinations.
Now, interest rates have been rising. Okay, they've peaked now, we hope, and they're going to start going down. But do you think there was a relationship with rising interest rates and more cash purchases, or was it maybe just a coincidence?
I think it's more a story of relative impact. So although we've seen rising interest rates and I might say, inflation problems, cost of living problems really affecting first home buyers in particular, but those that need to take out a large mortgage, it does make a big dent. For those that don't need a mortgage, it's just one less thing to think about and one less consideration in their purchasing decisions. So it just helps to explain why this group has remained fairly steady and actually increased a little bit. There is an element too of the interest rate transfer effect. So for older people or any people that have got significant savings or investment income, even superannuation funds, for example, a self-managed super fund, they may actually have seen an increase in their income as a result of rising interest rates. I'm not for a minute suggesting that that's true for all of this group, but it certainly is a consideration for some.
This is also a reminder of the depth and strength of our housing markets. It's suggested that there's about $11 trillion worth of residential real estate in Australia, but the total loans against that is $2.2 trillion, $2.3 trillion. In other words, the total loan-to-value ratio of Australia's housing markets is on the very low side. So while there's no doubt that some people are overcommitted their mortgages, some people are having difficulty paying their mortgages, overall our housing markets are very robust because there's lots of baby boomers who bought their homes 20, 30, 40 years ago and paid them off, other Gen X's or others who have paid off half their mortgages. So I guess this is just another sign that we really shouldn't be worried about that mortgage cliff or the other issues. Our housing markets are too big to fail, and the Reserve Bank and I guess the banking industry is not going to allow them to fail.
I think what it's telling us is that the housing market is, as you say, it's very large, but it's also quite complex, and there's fairly large segments in it that are less visible. So if we think back to the 2021 census, for example, we know that, a third of all households, around 11.5 million households, are owner-occupiers without a mortgage. And we don't tend to hear too much about that segment. Most of the focus is on renters and on homeowners who do have a mortgage to pay. So it's just as large a chunk, but less visible for many reasons. The other thing I'd note, though, which speaks to the complexity of this group, is what we're really picking up with this research is property transactions where there is no direct mortgage. But when we look at some of the postcodes that are, probably more heavily weighted on the investor side, what it's really suggesting to us is that those purchasers are not using direct mortgages. However, they may be using other forms of finance. They may be, for example, leveraging other assets and portfolio in their portfolio, or they may be getting their finance offshore. So a good example of that is looking at the postcodes 3000, Melbourne CBD,
yeah.
Sydney CBD, Brisbane CBD also came up, but not as strongly. All of these markets had quite large numbers and proportions of cash buyers, that is, buying without a mortgage. But we also know that, around 3/4 of residences in those locations are renters. So they are investment properties that are being purchased. So that's telling me that there's probably something else going on there. It's not the retiree market. It's a different cohort to what we see in the regions. So these inner central city areas, it's a mix of local and international investors who, for whatever reason, are choosing other forms of finance and not a direct mortgage.
Well, we know that there are many overseas investors, and we particularly talk about them from China, who are investing for different criteria than the Australians are. They're wanting to bring their money out from overseas and place it in what they perceive as a more secure environment. So that would make sense, what you're suggesting.
Correct. So we're really seeing a few different markets in this patchwork of cash buyers. So there's definitely that older domestic cohort, which is very much focused on the regional areas, and probably explains why Queensland is stronger than other states. But at the same time, we've got this inner urban story that doesn't really fit that picture. It's about different forms of finance for investment.
Very interesting. Okay, one of the other things that you mentioned in your report is about the intergenerational wealth divide. It touches on that. How do you think this trend of cash purchases is affecting housing affordability for younger generations, those without substantial assets?
Yeah, I do worry about that, particularly, when we see regional areas that were previously regarded as a bit of an affordability haven are really getting pushed above sort of the price points that are accessible for first home buyers. But of course, they are still accessible if you've already got a property. So to the extent that, the market's really dividing into those that have already in it, those who have already got a property, and those that are struggling to break in. And to the extent that that does follow generational lines, and it always will, it's just the nature of life cycle, isn't it? Building up assets over a lifetime of work and investment. It is becoming more pronounced, and it's extending to a greater range of locations.
I guess another way that's playing out is the bank of mum and dad now helping a lot of first home buyers get into the market, Julie.
Yeah, there is a bit of evidence from various sources around that type of assistance. And again, it's probably something that's always been there. Families have always helped each other, but it is being, documented and quantified now. So interesting research from Uhuri recently, for example, looking at the types of assistance. We don't know whether in the inner urban areas, for example, that might be a factor here. Most of the evidence suggests that Bank of Mum and Dad might pay the deposit, or they might provide a guarantor loan. I think it would be fairly rare that they would buy the entire property outright. For this cash purchase group in particular, you'd need to be able to do it without taking out any loans at all, which seems like a bit of a stretch for most families.
I agree with what you're saying. I was suggesting that there is a way of this intergenerational wealth being passed on nowadays with a warm hand rather than a cold hand when the parents die. It makes more sense to help your kids into the market now. So in Australia, the trend then is for a very significant portion of properties we're talking really about the big three East Coast capital cities being transacted with cash. Do you have any concept of what's happening overseas? How do we compare to other countries?
Yeah, Australia's property market does have some structurally different features to, say, the US or Canada or the UK in terms of the types of properties and the way that they are financed. Australians do tend to roll over and change mortgage providers far more frequently than in other markets. And a good example of that is when we think about sort of fixed loans in Australia, they're typically only fixed for 2 to 3 years, 5 years tops. Whereas in the UK, far more loans are fixed. So we do have, a bigger pool of variable. But then even when we think about our fixed loans, they are a much shorter tenure. So, typically five years plus in the UK, around 30 years in the US, which is a very long time.
Wouldn't we have liked to lock in at 1% and 2% interest rates for 30 years a couple of years ago, Julie?
Yeah, but doing it for 30 years, that's actually really difficult to get in Australia. I don't know that it's possible in our mortgage market. No. But it does mean that as a society, our housing market is more directly and immediately impacted by any changes to interest rates or lending conditions. Bear in mind, the flip side of that number with the cash purchases, 29%, that's telling us that the vast majority, 70+%, do in fact require a mortgage in order to be able to buy what they want. So, the availability and price of mortgages is vital. Definitely.
So you've gone back a couple of years in your reports, and over the last year, the percentage of cash-only purchases has increased. Is this an ongoing trend? Do you see any significant shifts moving forward?
I think it's an area that we at PEXA will definitely be investing more time in, and certainly I know that the RBA and the banks will be watching with interest to see if this changes. There is always going to be a structural element of purchases that don't require a mortgage for the reasons we've discussed. But it's probably too early to say whether, that is shifting structurally or whether it's a legacy of the interest rate changes.
Well, again, affordability is in the news a lot. The government keeps having discussions about it and committees to try and work it out. I've been around long enough to remember when in the past people said, my kids will never get into the home market. Properties are too expensive. I remember that in the 1980s. I started investing in the 1970s, but I do clearly remember that. And if we look at newspaper archives, it shows that affordability, whether it's rental or housing, has been an ongoing issue. On the other hand, it's interesting how many first home buyers are getting in the market over the last decade or so. So what advice would you give as a property economist to buyers in the current market, especially those who would be competing with these cash buyers?
For some buyers, it may be better to wait a little bit rather than rushing into the first purchase. I think the big advice is actually, now that prices have gone up considerably, transaction costs have also gone up. So one factor to consider is how long will your first purchase be your home for? Are you planning on flipping it quickly, or will you be staying in it long term? And I think just buying the first thing that you see that you can afford may not always be the best long-term decision. So it's about, that balancing act that we all need to make in investment decisions between the short-term affordability versus, long-term planning and a little bit more caution with whether it's suitable for you.
Well, with a third of property purchasers being investors, it's much the same thing as well. We know that more than half of them get out in the first 5 years because they've made the wrong investment decision. So rather than buying emotionally, have a plan, stick to the plan, be careful whose advice you get at the moment too, because I guess there's 27 million Australians who've got an opinion on property. That
Correct.
Doesn't mean you've got to listen to them though. But I think we are also fortunate that we're underpinned by an asset class that's going to keep increasing in value because our population is going to grow. Our government's got a business plan to increase our population to 40 million people by the middle of the century. Our wages are going to grow, more jobs are occurring and higher paying jobs. So have faith in the future, I think.
The fundamental drivers of property supply and demand in Australia are, as you say, relatively strong over the long term. It's just finding the niche that suits you as an investor and as a resident.
Definitely. Sure. I think one of the other lessons is that, as you said a moment ago, your first home's not going to be your forever home. And a lot of first home buyers want to start off with the sort of home it took their parents 30, 40 years to get as well.
That brings up some other trends, Michael, that are affecting property affordability that don't really get too much coverage but would be worth exploring in further conversations. So the first is home size and expectations. We think that has changed a little bit over the COVID years because of the work from home trends. It's exacerbated the pre-existing trend to larger homes and the preference for standalone dwellings rather than apartments. So that's the first thing to consider is, when we talk about affordability, particularly over a very long time period, we are looking at larger homes. The other thing that's happened is household density, household size is also declining. So when you put those two together, we do over time have larger homes with fewer people on average in each home. They're also relevant factors when we look at affordability. So, on a per person or a per square metre basis, the affordability challenge gets quite more complicated.
Well, some interesting things to discuss, and I look forward to having you back again on the Michael Yardney podcast, Julie. Thank you for those insights. It's something that not many people recognise or realise, and so it's great that PEXA has come up with this to just give us some insights into why our property markets have been so resilient. Look forward to chatting again soon, Julie.
Thank you, Michael.
I hope you enjoyed my chat with Julie Toth, Chief Economist at PEXA. And if you enjoyed the show, but you don't currently subscribe or follow the show, before we just move on, for a sec, just stop and whatever podcast app you're on, just subscribe to the show, follow the show, whatever your app asks you to do, so that twice a week you're going to get insights from the experts I have a chat with. By the way, it'd be great if you'd also review the show just to let more people find out about it. In a moment, I'm going to share my mindset message with you, but I think it's interesting that as we discuss things with Julie, it shows the strength and the depth of our property markets and how, despite interest rates going up over the last year, and they're going to eventually go down, but maybe not as fast as some people would like, there are certain segments of our housing markets that are not at all influenced by interest rates. Now, it's interesting that the markets have been very strong so far this year, and it's not often that all property commentators agree on something, but currently they all believe that 2024 is going to be a great year for property. And look, while I don't disagree with the the fact that they're all in alignment when they've had such a terrible track record of forecasts gives me some reason to worry about their predictions. But I guess the answer's simple. Our property markets will perform strongly, but they're going to be fragmented. This means only some properties are going to be what I call investment grade. And while there's a lot of properties for sale on the market, in my mind, less than 4% are what I'd call investment grade. That means many are going to buy a property investment are going to sell up in the next 5 years. Look, probably about 50% if history repeats itself. And of those who stay in the property investment game, it's likely that their properties are going to underperform the averages, again, if history repeats itself. So how do you beat these terrible odds? I guess you make the right decisions by getting the right advice. Successful property investors understand that getting independent strategic advice is an investment, not a cost. Now, you probably know about my team at Metropole. We're much more than just buyer's agents. We help our clients safely outperform the markets by giving independent property and wealth advice. And sure, we have a buyer's agency with our own teams on the ground, so we don't fly in and out. We have a buyer's agency that helps our clients buy property, but we've got a significant research department, and it all starts by having our clients start with a strategic plan, so they plan to become the people they plan to become. So we're big enough to tip the scales in your favour, but still small enough to care. So go to metropole.com.au and lock in a time to have a wealth discovery chat with one of our wealth strategists to learn how we can help you outperform the markets, as we've been helping clients with for over 20 years. We've got all the data, but more importantly, we've got the perspective to back up our recommendations. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to talk to you about why it pays to be an optimist. Look, what does it mean to be an optimist or a pessimist? In the world of philosophy, an optimist is a person who believes that good will ultimately prevail over evil and that our world is headed in the right direction. A pessimist is the exact opposite, somebody who thinks evil ultimately wins and that the world is doomed. It's just a matter of time before we self-destruct. Now, I don't think people are 100% one way or another. Most of us have both optimistic and pessimistic tendencies. For example, a lot of people have got very dark views about the future of technology or about the climate. Those same people might well be optimistic about green energy or the ability to educate others through social media. The problem is, if you look for evil, you'll find it. And that's why it's so easy to be a pessimist. If you look at the history of humanity, you'll see violence, war, injustice, inequality, pain, torture, famine. These are all negative things. I guess it's part of all of our DNA. Our ancestors did bad things. But if you believe the world's bad, you won't have a hard time finding evidence for that. There's still lots of suffering in the world. But here comes the kicker. There's less suffering now than there was 100 years ago, or in fact even 50 years ago. The world's no way perfect, but it's a little bit better than the past. Just a little bit. And that tiny bit of improvement, well, that's in my mind a case for optimism. Now, while we don't know exactly how many people are born optimists or born pessimists, I assume the latter group, the pessimists, are in the majority. It's part of our DNA, as I said. It's probably got to do with people's background as well. When life's hard, you tend to fall in a negative downward cycle. When bad things seem to happen to you and to the people in your life, it's hard to imagine things are going to get good. You need a really good reason to change your whole outlook on life. But if you can be optimistic, it's going to make your life a lot better. And that reason is the promise of a better future. When you see examples of people who've made something out of themselves from nothing, well, there you go. You've got proof. You can build a good life. You can get educated. You can become wealthy. You can become a successful investor. But you have to believe that the world's going in the right direction. To be blunt, as a property investor, you need to be bullish about the future. In my mind, one of the main reasons Warren Buffett is successful is not because he's the best stock picker in the world. Yeah, of course he's a good stock picker, but more than anything else, he's optimistic and he's patient, a combination of personality traits not a lot of people possess. While other global investors screamed fire and warned the world's about to crash and bear markets are going to plummet, Buffett's been optimistic for most of his 80 or so years of investing. And even in the 1990s, when he started receiving global fame, he repeated one thing over and over again publicly. He said, "Never bet against America." At the 2020 annual shareholders meeting of his firm Berkshire Hathaway, at the peak of the initial global pandemic, the COVID pandemic, he reiterated the same message. Buffett spent the first part of his meeting talking about all the good things that happened. He said in the 231 years, nobody in their wildest dreams would have thought that in the next 3 lifetimes, the United States would have had 280 million people, that aeroplanes would fly at 40,000 feet. He said that we'd have a great hospital system. Everything has just exceeded anybody's dreams. Yes, Warren Buffett's an optimist. By the way, so am I. And in my studies, I've realised that optimists behave differently. By the way, every successful long-term investor is an optimist. Otherwise, why put money into assets? When you adopt an optimistic perspective on the world, you behave differently. You have faith in the future, so you invest in your education, you maintain your health, and you steadily invest in assets. You realise the world's going to keep improving, and you don't want to be left behind. Of course, it's a very different way of living, a very different way of thinking than the pessimists. And boy, do I see my share of those and the trolls on the internet. Over the past 20 years, look, we've seen many crises, from wars to financial collapse to global pandemic. And as humans, as a group, we've just kept improving through all these challenges. It doesn't require much imagination to realise we're going to keep improving. I've never seen a successful, wealthy pessimist, so my message to you today is be an optimist. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?